Hello, good morning. My name is Jamal Khan. I'm the head of tax at Churchill Tax Advisers, and we are running our weekly tax update. Before we go into tax cases that have been announced recently, I'll cover some hot topics around property taxation. One of the hot topics at the moment is landlords wanting to put properties into a limited company or incorporation of properties. I have seen a number of people in the last 2 weeks, let alone the last 2-3 years, which was a significantly larger number, but people come to me, or clients come to me to say that we want to transfer properties into a limited company, and so they've been advised by their accountants or whoever. It's such an easy process, transfer all the properties into a limited company. There are a lot of steps to be followed to avoid any tax implications on transferring a property into a limited company. First of all, when you transfer a property into a limited company, effectively you are going to raise a capital gains tax charge, which could be substantial amount, depending on when you bought the properties and how long you've held them for and how long they've gone up in value. The second point that we need to consider is whether there will be any stamp duty on it as well. Although you might own the properties and you might own the limited company 100%, but limited companies are treated as third-party independent legal entities, and therefore any transfers to them are at arm's length. So when you transfer property into a limited company, it will be subject to capital gains tax and stamp duty. To overcome these, you need to consider, first of all, if you're carrying on a trade of a property trade whilst you're managing your properties, which requires you to work at least 20 hours a week managing your properties in order to qualify for a special exemption from capital gains tax. That's fine, but that exemption doesn't apply to stamp duty. So whilst a lot of people say, oh yeah, I spend 20 hours a week looking after my property portfolio, but that exemption doesn't apply to stamp duty, so you'll still be liable to stamp duty. For that, you need to consider setting up a partnership, hold the partnership for a number of years, but even then there are some anti-avoidance legislation, for example, Section 75A of which can apply, and HMRC can come back and charge stamp duty. So a lot of advice needs to be taken. Incorporation also has implications around long-term inheritance tax. So yes, it might help you save some interest, etc. Tax relief on mortgage interest, but it doesn't help you save inheritance tax in the long run, which could be a substantially bigger figure. So we are advising quite a lot of clients on tax efficiently setting up property portfolios, or whether they should or should not incorporate. Okay, moving on to our tax cases for the week. First one was Mr. Awolesi versus HMRC. This is a case of penalties that have been imposed by HMRC for late filing of a couple of years of tax returns. The penalties were the appeal against the penalties was made very late, 2-3 years later. The matter went to the Tribunal, and HMRC was saying, we're out of time, you can't even appeal. But the judges disagreed. The judges said that, first of all, the notices were not issued properly by HMRC officers. They were issued by computers, and there were no valid notices of to file tax returns. That was enough evidence for HMRC to lose its case, and the appellant won. The next case is that of Mr. and Mrs. Potter versus HMRC. This case involves entrepreneurs relief, and this is a very interesting case for those who wish to claim entrepreneurs relief. Now, they operated a company that had some contracts with banks. They provided consultancy services. It was effectively offering brokerage services. They had a few contracts with a couple of banks, and then the contracts ended in 2009. The last invoice was raised in 2009. They continued to look for work, but they couldn't find any work. Ultimately in 2014-15, the company was put into liquidation. The company had some reserves. They took the reserves out, claiming entrepreneurs relief. HMRC objected. They say the company has not traded, and therefore entrepreneurs relief traded in the last 12 out of 36 months. Therefore, entrepreneurs relief is not available. The matter went to the court, where the judges looked at the position in detail and came to the conclusion that whilst the company was actually not trading, but the director's intention was to trade, they were actively looking for contracts, but they could not find any contracts. And because of that, they qualified for entrepreneurs relief. HMRC's second objection was that even if they were trading, it wasn't significant. The judges disagreed. The judges said, well, their only activity was that to look for new work, and therefore, even if there was no activity, it is deemed as significant because they were actively looking for work. And therefore, HMRC lost their case, and the appellants won the appeal. The next case is that of Catton versus HMRC. This is a VAT case. Husband ran a restaurant, wife ran a cafe shop next door, or vice versa. HMRC, they both filed separate VAT returns, separate income tax, corporation tax returns. HMRC came and they said, well, no, they should be joined together, and the VAT registration date should be backdated, and they should be charged penalties for not filing. The Mr. and Mrs. Catton appealed, and they said, no, these are two separate businesses. The matter went to the tribunal. And in the tribunal, the judges looked at each case. In fact, the husband was helping the wife was helping the husband, but effectively they had a separate menu, they had separate suppliers, they had separate accounting systems, they were managing everything differently. And therefore, although one of the points raised by HMRC was that they shared the same toilet, which is fine, many people share the same toilet, but doesn't mean that the business is the same. After looking at various facts, the judges agreed that these were separate businesses and could not be combined, which, if they were combined, would have resulted in a significant amount of tax being lost by Mr. and Mrs. Catton. Thank you very much for listening to this week's update. And if you like our updates, please subscribe to our YouTube channel, and we shall see you next week. Thank you.